Wall Street is now 100% convinced that it's going to be a soft landing. So I'm going to take the other side of that. I think it's going to be a very hard landing. As a matter of fact, I'm in the crash landing camp right now. So for there to be a scenario where there is no recession, a lot of things have to be wrong that would have usually been very good predictors. For example, the yield curve has been inverted for about a year and a half now. It is the longest inversion of a yield curve in 43 years. 43 years is a long time. That's the longest and steepest inversion of a yield curve. Also, the index of leading economic indicators has to be wrong. The National Federation of Independent Businesses, their survey of business confidence, small businesses, that has to be wrong in order for us to avoid a recession. I just don't think it's different this time. I'm looking at these three reliable indicators, but there's a lot more. There's a lot more things that have to go right. And Wall Street has priced in an earnings per share growth of 12% in 2024. Now, nominal GDP is crashing from 9% down to probably well below 5%. So I just don't understand how, even if I'm wrong about a recession, how in the world are you going to get a 12% growth rate in S&P 500 earnings when nominal GDP is less than half of it? It's just not going to happen. Small businesses employ over 50% of people in this country. So when you go out and make your wild bets on a booming economy, it's just nauseating how I continue to hear the pablum, all of these people coming on CNBC and Bloomberg and the mainstream financial media tell you that, hey, the soft landing is virtually guaranteed. Put me on record. I'm absolutely 100% against that. I mean, you have to know, there are now 62% of Americans now living paycheck to paycheck. That's a record high. And they're paying a record high amount of interest on credit card debt. And that balance is at a record high. There's a 59% surge in corporate bankruptcies this year through November so far. That's better. That's more than all of last year's total, according to the S&P Global. These are not, I don't make up stuff. This is real information. There's $1.8 trillion of corporate debt that needs to be refinanced over the next 2 years. And that rate, again, it's double than when it was just a couple of years ago. And you have to also believe that the real estate bubble is going to remain inflated, even though rates have surged for mortgages. So, I mean, listen, I am not net short in the portfolio. You might think that from hearing what I have to say that I am. I'm just not yet. Because amazingly, miraculously, the financial conditions are easing into all of what we're talking about. Still, now I'm going to answer the question why I think that's happening in a second. I just want to also say that credit spreads are tightening as we speak. So I'm looking at March, and please do not hold me to this date because only God knows when this is going to turn. Right now, I'm net long in the portfolio, happy to be long in equities and some gold and bonds, primarily on the short end of the yield curve. But March of next year is when I think it's going to be time for phase 2 of the bear market, which is still firmly in place. We're still not higher than we were in November of 2021 in the S&P 500, even with the Magnificent Seven. Let me explain to you why I think March is going to be a big problem. Right now, there's a tremendous amount of liquidity coming into the market through the reverse repo facility. There was over $2 trillion parked there. Banks' excess reserves were parked there out of the economy and earning interest from the Federal Reserve. Fine. But the Fed started its quantitative tightening program, and that has already drained about $1 trillion from the banking system. But that's being offset by the $1 trillion that's coming out of the reverse repo facility. $2.3 trillion from the RRP. Now it's $800 billion. According to the history that I'm looking at and the vector of the withdrawal, in March of 2024, the reverse repo facility will have about $200 billion left in it. And that's the minimum that it needs. And that means if the Fed continues with quantitative tightening, that's when you'll see financial conditions tighten. Because that $95 billion a month that they're draining is pure burning of reserves in the base money supply. That's when I think the stock market starts to fall. And that's when I think the economy starts to sputter too. So I am myopically focused on that time frame for when I think phase 2 of the bear market can resume. We have a situation now where I believe that we need high interest rates, interest rates that are real, in other words, above inflation, to bring down inflation. But at the same time, if interest rates are high for very long, the federal government is insolvent. Think about that for a second. And I'm not trying to be hyperbolic here. I'm stating facts. Even Janet Yellen said today that it's an existential crisis for our fiscal future if interest rates stay high. But if interest rates don't stay high, it's an existential crisis for the middle class of this nation. So I just want to start off on that point. It's also kind of bothering me that there's a lot of FOMO out there, fear of missing out. It's as if, okay, forget about 2000 when the market lost 50%, S&P lost 50%, the NASDAQ gave up 83%. Forget about 2008 when the S&P lost over 50% and the home prices crashed by 33%. Forget about all that. Even fast forward till today, we have a very unstable and volatile regime here. 2018, the Federal Reserve had to promise to stop raising interest rates when they hit 2.5%. We're at 5.25, 5.5, with a lot more debt and a lot bigger asset bubbles. But they had a promise to stop hiking interest rates. In order to stop the debacle that took place from October to the end of the year, down, plunging 25% straight down. And then fast forward, of course, okay, 2020 was a disaster, the first part of the year, where the S&P lost 30-something% in 1 month. That's because of COVID. Let's just excuse that. But what about 2022? In 2022, the S&P fell 20%. And I think 2024 is going to be another debacle. The Russell 2000 is down 25% since November of 2021. That's 2,000 stocks. That's not the Magnificent 7 AI stocks. I mean, outside of that, if you look at the average stock in the market, it's either pretty much in the flat area or down. We're only talking about 7 stocks here that have done anything. The KRE, which is the Regional Banking Index, that is down 17% this year alone. So there's a lot of pitfalls in the thought process of, hey, I'm missing out on something by not being bullish on the S&P 500, on CNBC, or even unfortunately on the American economy, the housing market. This is a very tenuous situation we have in the housing market. I believe there's reasons to rationally conclude that the real estate market today is worse than it was leading up to the global financial crisis. So there's a lot of problems out there. That doesn't mean I'm a perma bear. You can ask my clients who I manage money for. I was very bullish at the end of 2020, did fine. 2021 was a great year for us going long the stock market. So, but for me now, I'm cautious. I'm still net long. I'm not net short the portfolio yet. I will come on and let you know when I see my proprietary financial conditions index tighten, when I see credit spreads start blowing out. That's when I'll know when to get net short. Still long, but I'm also cautious. The next step, I think, for this economy and this market is for a deflationary recession. Could be very deep, very damaging to the equity market. Well, first of all, the 60-40 portfolio, let's say, is dead and buried, because when the Federal Reserve put the bond market and the equity market and the real estate market in a triumvirate of bubbles by taking interest rates to 1% or below for 11 of the past 14 years, from 2008 to 2022. That's what you get. I mean, if the real estate market is in a bubble, and if the bond market is in a bubble, and if the equity market is in a bubble, then guess what? Your 64 portfolio doesn't work so well. But here's the difference, right? Here's what happened since 1987 all the way to 2022. Actually, 2020. Sorry. Whenever there was a problem in the economy, a hiccup in consumption, or whenever the stock market went down, the Pavlovian response from the central bank was to cut rates, because they had the cover to do so. Because what was the problem? The problem was inflation wasn't high. That was the problem. That was their mantra. I mean, I don't believe inflation above 0% is a very good thing. There's nothing wrong with a slight little bit of disinflation. That's wonderful, or deflation. But here's what changed. Post-COVID, we finally did something that we were promised would never happen in the United States, which was the launch of helicopter money. We were promised that the United States of America, with its world reserve currency status and its golden balance sheet, would never go down the road of borrowing or printing trillions of dollars and handing it out to people directly, bypassing the banking system, sending people checks in the mail. We did it. We did Yeah, $6 trillion of it, okay? So that led to inflation. Inflation was the problem. So now the next time we have a crisis, let's just suppose I'm correct. Just, cede me that little slack here and say that 18 was a problem, 2020 was a problem, 2022 is a problem, and 2024 is another problem. What is the Federal Reserve going to do, Dunnigan, the next time there's a crisis? Are they going to, in a Pavlovian response manner, just cut rates to zero summarily? And are they going to launch some QE program? And is the Treasury going to announce a new round of helicopter money when the nation is insolvent? Are they going to do that with alacrity, expediently? No. They can't. They cannot. Because if they do that, they're staring hyperinflation directly in the eyes. Intractable stagflation at the very least. So that's the real problem. The salient issue now is the next hiccup. This is new. This is something we haven't seen in over 40 years in this country. We now have a problem with inflation. And that inflation demands an interest rate that is north of inflation. But an interest rate north of inflation bankrupts the Treasury. Now, if you don't want to acknowledge that, that's fine. If you want to go and call your broker and say it's time in the market, not timing the market, because most money managers are salespeople. They're asset gatherers. They're not economists. They're not market strategists. They're salespeople. And the mantra from salespeople is, hey, just buy and hold a diversified basket of stocks and bonds and you will be fine. And for most of our lives, and even the lives before us, that was the case. But it's no longer the case because we have an artificial economy based on artificial interest rates that have built up and erected massive bubbles in stocks, bonds, and real estate and rendered the amount of debt outstanding untenable under a real interest rate regime.